Hello, my name is Demetrius Lane. I am the owner of Medicare Champions. I'm also a representative of Mutual of Omaha, and I found this information and thought it would be very valuable to the families that I serve. So I'm going to present it to you today through this PowerPoint. If you have subscribed to my page, which is MedicareChampions.com, you will have access to this recording and this video at any time. So let's get started. Social Security simplification. Social Security was enacted by Franklin Delano Roosevelt as a result of the privations he saw throughout the country during the Depression. Most hard hit were the aged, widows, and orphans who had to try to survive at a time when many men were unable to get jobs. Without a male breadwinner, this part of the population was the poorest of the poor. Franklin Delano Roosevelt wanted to do something about that so that it wouldn't happen again. That is why in 1935 the program was created. At that time, the worker to retiree ratio was 16 to 1, and the average person who survived to age 21 was expected to live to about age 65. If you live to age 65, you will be eligible for benefits for about 13 years before you passed on. At that time, there was about 7 million people who fit that criteria. It would have been hard for our government to imagine what America looks like today. Our worker to retiree ratio has changed to 3 to 1 and will be 2 to 1 after the baby boomer cohort is fully retired. Thus, it isn't hard to understand why legislation has recently changed some of the claiming possibilities, like filing and suspending benefits. This presentation is intended for general informational purposes only. This information is not an offer to buy or sell any security or investment product. Mutual of Omaha Investor Services Incorporated and its representatives do not provide tax or legal advice. Any tax or legal information provided here is merely a summary of our understanding and interpretation of some of the current income tax regulations and is not exhaustive. Tax law is subject to frequent change, therefore it is important to coordinate with your tax or legal advisor for advice regarding your specific situation. Why are we here? Number one, to better understand the Social Security benefit rules and how they have changed over the years. Two, identify some of the misconceptions about Social Security benefits. And three, help you determine the best options for electing Social Security using some of our tools and strategies. The Bipartisan Budget Act of 2015 became law November the 2nd, 2015. The Act makes significant changes to the Social Security program that might impact the payments you will qualify for in retirement. The law eliminates over time several Social Security claiming strategies, which the bill refers to as unintended loopholes, that some married couples and families use to increase their benefits. I want to talk about some of these changes in more detail because they could have far-reaching ramifications for you and your loved ones. We'll talk about these today. And it's important to note that 73% of retirees take early benefits, even though that's rarely the right thing to do. I think many times early benefits are elected because people either aren't aware of their options or their faith in the system is poor. With longevity climbing to ever higher ages, this is an important consideration. Why it's important to get it right. Many baby boomers rely on Social Security benefits, which account for 37% of the income of those 65 or older in 2015. Later stage baby boomers who do not have access to government or private pensions must rely on other investments or current employment to supplement their Social Security. This can present a problem because it is hard to determine how long your assets must last. With life expectancies so much higher than they were during the Depression, for some of us, our savings must last 20, 30, 40 years into retirement. Social Security may also be the only benefit you have that is tied to a cost of living adjustment, which is key to maintaining purchasing power. When you apply for benefits, you will need to have some documentation to prove your identity. You'll need your Social Security card or birth certificate, an official photo ID, last 2 years of tax returns, and a bank account for direct deposit. If you're married, you need to provide proof of the marriage. If divorced and planning to claim on those benefits, you will need a copy of the divorce decree. First, let's start with some of the basics. Eligibility. You have to make sure you're eligible. In order to determine this, the Social Security Administration uses what it calls credits. You can find out how many credits you've earned by contacting the Social Security Administration. Although special situations exist, a person aged 62 or older today needs 40 credits to receive retirement benefits, which generally means 10 years in the workforce. In 2019, you receive 1 credit for each $1,360 you make. You can earn a maximum of 4 credits per year. Receiving enough credits shouldn't be an issue for most in this room, but I wanted to talk about it because there's a common misconception that those who have earned 40 credits will receive the maximum monthly benefit amount. This is incorrect. Remember, credits only determine whether you qualify for benefits. Before we go into details, let's quickly go over some terms you'll need to know. The first is AIM. This is the average of your monthly earnings over the 35 best years of working and paying into Social Security. The other term you'll hear a lot is primary insurance amount, or PIA. This is a calculation by the Social Security Administration that represents the amount you will receive if you started taking benefits at full retirement age. Next is your full retirement age, or FRA. Full retirement age, also known as normal retirement age, had been 65 for many years. However, beginning with people born in 1938 or later, the age gradually increases until it reaches 67 for people born after 1959. These terms are used as a starting point for calculating reductions or increases in benefits. Simply put, you'll receive 100% of your primary insurance amount if you file at full retirement age, but we'll get to that later. Based on the increase of the Consumer Price Index from the third quarter of 2014 through the third quarter of 2016, Social Security and Supplemental Security Income beneficiaries will receive a 0.3% annual cost of living adjustment for 2017, a 2% increase for 2018, and will receive a 2.8% increase in 2019, which is the largest annual cost of living adjustment in 7 years. You should always want to consider whether you should take early or later benefits. If you are not widowed, you can take benefits as early as age 62, but benefits are reduced by a small percentage every year to take into consideration the fact that they are collecting them earlier. If you take benefits at age 62, you will lose approximately 30% of your full benefits, but you will collect them longer. Whether it makes sense for someone to take the earlier benefits depends upon many things, not least of all, how long they think they will live to collect benefits. This is called your break-even age. The age that you can take full benefits depends on when you were born. It was 65 for those born before 1938. After 1939, it gradually increased by a month at a time until it reached age 66 for those who were born from 1943 to 1954. If you were born in 1955, you have a full retirement age of 66 and 2 months. For those born between 1956 and 1959, it gradually increases. For those born in 1960 or later, it is 67. The longer you delay benefits until you are age 70, your benefit will increase. Currently, it will increase 8% per year for every year you delay. Now, to calculate your benefit, Social Security looks at your top 35 years of Social Security wages, indexed for inflation. Those 35 years are added together, adding in 0 for any of the 35 years without income. Then divide by 35. Then divide by 12. The result is your average index monthly earnings. AIM is then linked by formula to the basic retirement benefit result or primary insurance amounts. This is the amount paid at full retirement age. You can apply for Social Security benefits in person at your local Social Security office or online at SSA.gov. If online, you set up an account by entering in some personal information and pick a login name and password. You also might get paper statements in the mail for workers age 60 or and older 3 months before their birthday. If they don't receive Social Security benefits and don't yet have a My Social Security account, workers who don't want to wait for their scheduled mailing can request a paper filling out form online. The statement will then arrive by mail in 4 to 6 weeks. The SSA.gov site is very easy to use and contains all the information that you might need relating to your Social Security benefit and including policy changes proposed. You can use the calculators there to project your benefit, and you can get client-facing publications that explain provisions like windfall elimination. However, the site does not provide an optimization calculator. After you enter the site, review your benefit estimate statements to make certain your earning history is accurate. It is important that it is right because this is what is used to calculate your AIM and then your PIA. This leads us to a very important aspect of your Social Security planning. When should you start receiving benefits? This is crucial because your benefit amount will be adjusted significantly depending on when you file. There are 3 time periods in which you can elect to begin benefits. These are full retirement age. You can begin benefits when you reach full retirement age, probably age 66 for most of you, and receive full benefits, or age 62. You can begin benefits the first full month you turn 62 and receive reduced benefits. Age 70. You can delay benefits up to age 70, in which case you may receive delayed retirement credits, or DRC. Your estimated benefits are based on current law. Congress has made changes to the law in the past and can do so at any time. The law governing benefit amounts may change because by 2034, the payroll taxes collected will be enough to pay only about 79% of scheduled benefits. Now, on that last slide, there was a disclaimer statement included from Social Security Administration. Currently, on the Social Security statement, there is a disclaimer about the fundedness of the system in the future when the retirement trust fund is exhausted and the worker to retiree ratio declines. Benefits may be cut for taxpayers at some point. When calculating your retirement income, this may be important to take into consideration. Some of the fixes that may occur in the future: increase of Social Security tax rates, higher maximum earning subject to Social Security tax, increase of the full retirement age, decrease of future retirement benefits, or reduction of future cost of living adjustments. Now it's time to talk about the acronym Social Security uses, which will help you understand some of the terminology you might hear or read. So what is the maximum benefit available? If you retire today at full retirement age, the most you can receive monthly is $2,861. But the truth is, most retirees do not receive the maximum benefit amount. This table shows average payments for a single retired worker and a retired couple. Again, this is why it's important to work with your financial professional to understand your benefit amounts. If you are a high income earner, you do not pay FICA taxes on any amounts that you earn over $132,900 in 2019. Because of this ceiling in Social Security taxes, Higher salary people receive less of a fractional income replacement from Social Security benefits, so they need to save more personal wealth if they want to replace their current income in retirement. The limit was $128,400 in 2018. The system does not reward early claimers. If you work after taking early benefits, you can only earn a nominal amount or your Social Security benefits will be reduced. This is not a tax, but a withholding that is paid forward until you do fully retire. The reduction is $1 for every $2 you make over the maximum income, which is currently $17,640 in 2019, which is an increase from 2018, which was $17,040. If you retire in a year where you are not yet of full retirement age, but you will be in a matter of months, you may also be subject to a reduction in benefits, which is applied monthly. This reduction is $1 for every $3 you earn over $46,920 in benefits. Some people who retire in mid-year have already earned more than their yearly earnings limit. That is why there's a special rule that applies to earnings for 1 year, usually the first year of retirement. Social Security is available for your spouse even if they did not work. They will always receive the greater of their own work record benefit or 50% of their spouse's full retirement age benefit. For example, if your spouse's benefit is $1,800 a month, $900 is your spousal benefit, and your worker earned benefit is $1,100 a month. You'll get the $1,100 a month. If you and your spouse file simultaneously and you do not qualify for a restricted benefit election, you will be deemed to have filed for the highest benefit available to you. This is called the highest benefit rule and precludes you from collecting any delayed retirement credit on your record at that time. Your spouse must have started collecting benefits for you to claim off their worker benefit. If you are a widow without dependents, meaning children under age 16, you will not be able to get a widow's benefit until you are age 60. This is called the blackout period. After age 60, you can get a benefit, but it will be reduced substantially for early filing. Your benefit is also subject to the earnings limitations rule. So if you make over $17,640 as a widow, you will also see reductions in your widow's benefits. If they remarry before age 60, the widow's benefit is lost for their former spouse. If they remarry after age 60, they can choose which spouse to claim spousal benefits from. What does windfall elimination provision mean? This relates to a job from which you receive a pension, such as a public school teacher or government worker. During your time at this job, you did not contribute to Social Security, but you have also worked at other jobs where you did contribute to Social Security and worked long enough to qualify for benefits. The pension you receive from the job for which you did not contribute to Social Security will reduce your benefits by as much as half of your pension. Note, if you paid Social Security tax on 30 years of substantial earnings, you are not affected by the windfall elimination provision. The chart shows the maximum monthly amount your benefit can be reduced because of the windfall elimination provision if you have fewer than 30 years of substantial earnings. There are other exceptions to this rule, so check with us if you think you have someone who may be impacted. Our timing software can accommodate the calculation if it applies. If you receive a pension from a government job in which you did not pay Social Security taxes, some or all of your Social Security, spouses, widows, or widowers' benefit may be offset due to receipt of that pension. This offset is referred to as the Government Pension Offset or GPO. The GPO reduces the amount of your Social Security, spouse's, widow's, or widower's benefits by 2/3 of the amount of your government pension. For example, if you receive a monthly civil service pension of $600, 2/3 of that, or $400, must be used to offset your Social Security, spouse's, widow's, or widower's benefits. So if you are eligible for a $500 spouse's benefit, you will receive $100 per month from Social Security. There are exceptions to this reduction, and a client-facing explanation is available on the SSA.gov site. There is also a calculator. So let's consider what has changed in the new legislation passed in November 2015. The Act makes significant changes to the Social Security program that might impact the payments you would qualify for in retirement. The law eliminates over time several Social Security claiming strategies, which the bill refers to as unintended loopholes, that some married couples and families use to increase their benefits. I want to talk about some of these changes in more detail because they could have far-reaching ramifications, and more importantly, there might be some of you who still have the option to use one of these claiming strategies. Let's first review some claiming strategies that are available for a short time period depending upon your date of birth. A switch strategy allows some individuals to take one benefit for a period of time while allowing another benefit to grow, and then later switching over to that larger benefit. File and suspend. Voluntary suspension. In 2016, a person who is at or past full retirement age and files for benefits before April 29, 2016, could have filed for their individual benefits and immediately suspend receiving them. This would have allowed their spouse or dependent to collect a benefit off their record, in addition to them getting an 8% increase to their benefit until the age of 70. Voluntary suspension, available from age 66 to 70, has been a powerful tool for maximizing Social Security payouts, but it is limited now for qualifying individuals who elected prior to May 1, 2016. Restricted application. Also want to discuss restricted application. Anyone who turned 62 by the end of 2015 has the option to file a restricted application once they are at or past full retirement age and if they have not elected any benefits. If eligible, a spouse has the choice to collect a spousal benefit only or elect their own individual benefits. When the spouse decides to collect spousal benefits, their own individual benefits can continue to grow at 8% interest per year and earn delayed retirement credits. This strategy is potentially a great way to enhance Social Security income, similar to voluntary suspension. There is a limitation now for this claiming strategy for those who did not turn 62 by the age 2016. They do not have this option. As we discussed, the Bipartisan Budget Act of 2015 made significant changes to the switch strategies, effectively creating three different sets of rules depending on when you were born. What is important is it did not impact those individuals who have already implemented a plan. First rule: those born on or before May 1, 1950, due to the passage of the May 2016, the option to elect benefits and then request a voluntary suspension is no longer available. The request for voluntary suspension has been made prior to April 29, 2016. If you are one of the fortunate ones who did elect, then your spouse or dependent children will be able to continue to collect off your retirement benefit while your benefit is in suspense, earning delayed retirement credits. After April 29, 2016, the file and suspend strategy is no longer available. In a nutshell, for a spouse or dependent to collect the benefit, the original filer will have to file for their own benefit and be required to collect the benefit, thus foregoing the 8% increase under the delayed retirement credits provision. If an individual's payments are currently suspended, or if they requested to suspend before May 2016, they are under the old rules and reap all the rewards. Remember, the Act changes the rules so that if you were not 66 by May 2016, or you did not suspend your Social Security payments by May 6, 2016, your spouse or your children who receive payments based on your work record will no longer receive them until you start receiving your payments again. So if you are born January 1st, 1954 or earlier, now age 65, you can still restrict your benefit at age 66 and claim a spousal benefit. If you were born before January the 1st, 1954, age 65 in 2019, an individual who is eligible for both a spousal benefit based on the work record of a spouse and a retirement benefit based on his or her own work record can choose to elect a spousal benefit at full retirement age and let their own benefit earn delayed retirement credit until age 70. This will allow his or her own benefit to accumulate 8% per year credits and then switch to his or her own larger benefit at any point in the future up to and including age 70. Now, for the rest of us, if you were born after January the 2nd, 1954, not 62 by the end of 2015, you can no longer use switch strategies. Anyone under the age of 62 in 2016 will not have the choice of which benefit to elect when they reach full retirement age. Regardless of their age and when they elect to take benefits, they will be deemed to have filed for the highest benefit. For example, if Jane, currently age 60 at the end of 2015, has an individual benefit of $1,400 at full retirement age and is eligible for a spousal benefit of $1,200 at full retirement age, she will be given the higher of the two amounts when she files for her benefits at full retirement age. In this example, Jane will be deemed as filing for both and will be required to take her individual benefit of $1,400 versus taking the $1,200 spousal benefit and letting her individual benefit grow 8% per year until 70. This is a major development in Social Security planning and needs to be addressed in your overall financial income planning. One nice thing is that the legislation did not negatively impact widows. All widow planning options are still available. The age requirement we discussed do not impact widow benefits, only spousal and retirement benefits. This is good news because it means that a surviving spouse of a deceased worker can still apply for and receive survivor benefits while receiving the 8% automatic increase on their own benefit amount, giving them the opportunity to move to a higher payment amount at a later date. You can receive widow's benefits as early as age 60. If you take benefits at age 60, you'll only receive 71.5% of the full benefit. If you're widowed and not yet 60, there is a blackout period where you may not be entitled to benefits unless you have minor children. Then they will get a benefit. If the deceased spouse was receiving reduced benefits at death, survivor benefits will be reduced accordingly. Unless you wait until full retirement age to claim them, then you will get 100% of the benefit earned by your former spouse. A survivor can take spousal benefits and switch to their own worker benefit later if it's more beneficial. If you are divorced, make sure you consider whether or not you may qualify for benefits based on your ex-spouse. If you are married at least 10 years and have not remarried, your former spouse will not need to know that you have filed, but you do need to bring a copy of your divorce decree to prove the marriage. An eligible divorced spouse loses the right to collect benefits on an ex if they remarry. But widows and widowers retain the right to claim survivor benefits if they wait until 60 or later to remarry. So a divorced spouse who remarries loses the right to collect benefits on a living ex, but can still collect survivor benefits on a deceased ex if the divorced spouse waits until 60. to take the second trip down the aisle. Strange exception. The marriage of a divorced spouse will terminate entitlement to such benefits unless the divorced spouse marries someone who is also entitled to benefits as an ex-spouse or widower. In other words, if two people who are each collecting Social Security benefits on a former spouse's earnings record, they can keep those auxiliary benefits when they remarry. After you have been divorced 2 years, you can file for benefits whether or not your former spouse has filed for their benefits. The normal reduction applies. You cannot participate in delayed retirement credits, however. So if your ex waits until age 70, it does not benefit you. Note, if you were born before January 2nd, 1954, and have already reached full retirement age, you can choose to receive only the divorced spouse's benefits and delay receiving your retirement benefits until a later date. The final change I wanted to discuss applies to suspended benefits, which we discussed earlier. Prior to the BBA 2015, those with suspended benefits could elect at any time to request payments retroactive back to their filing date. For example, if a man filed for Social Security at age 66 and then suspended his payments, his benefits would grow at a rate of 8% per year. However, if the man came down with a life-threatening illness at age 68, he could retroactively unsuspend his benefits. He would lose the 16% bump in pay he should have received from deferring payments, but Social Security will send a lump sum payment for the past 2 years. Future monthly payments would be made at the same rate the man would have received had he started his benefits at age 66. This has been a very valuable strategy for someone who had a change in health or financial status. It allowed people to hedge their bets by establishing a filing date for Social Security. They could defer their monthly benefit amount and let it grow, but also rest assured that they could receive that money retroactively if needed. Under the new rules, Social Security beneficiaries can no longer receive retroactively unsuspended benefits. In the example above, if the man needed to start receiving benefits at age 68, he could still unsuspend his filing. He would not receive a lump sum payout for the previous 2 years, but he would begin to receive his monthly payments at a higher rate thanks to the deferral. Many retirees are surprised and dismayed to discover that a portion of their Social Security benefits could be taxable at ordinary income tax rates. Whether or not you're taxed depends on what's known as your provisional income. It used to be so simple. Social Security benefits used to tax-free income, period. But then as a part of the Save Social Security plan, Congress decided to tax up to 85% of your benefit, with the extra revenue going to shore up Medicare. In 2019, you can receive Social Security benefits tax-free if your provisional income is less than $25,000 on a single return or $32,000 on a joint return. If your provisional income is more than that, you will be taxed on a portion of your Social Security benefits. Provisional income is a calculation using your adjusted gross income, not including Social Security, plus 50% of your Social Security benefits plus any tax-free interest from municipal bonds. With this list of assets, when income is generated, that income will be considered when calculating provisional income. Don't forget, only half of your Social Security income is used in this calculation to determine how much of your Social Security benefit is taxable at your income tax rate. And remember, there are rules that must be followed in order to life insurance or Roth assets to not count as income and be included in your provisional income. As you can tell, using a timing calculator to quantify the best scenarios for electing both spouse and worker benefits is critical. It is also important to use your actual benefit statements. You can print your statements using SSA.gov and creating your account. We have tools that can help provide your estimated Social Security benefits, or you can find calculators available. Mutual of Omaha advisors can provide you with the Social Security timing report to help analyze what your best case scenario could be when electing Social Security benefits. What happens when one spouse passes away? A Social Security check is eliminated. Do half the expenses go away? How is that income going to be replaced? If you are widowed, you have the option to claim a widow's benefit as early as age 60 and 50 if you're disabled. But the benefits you received are dependent on several factors. One certainty, though, is that you will only receive one check as a survivor. Remember, if your spouse claimed early benefits, your widow's benefits will be reduced, and if you file early, there will be an additional reduction. Also, if you continue to work, your widow's benefit is subject to the earnings test. But there is a solution to this problem. Life insurance can provide a lump sum to supplement that income loss. If you have life insurance, the death benefit can help you replace that lost income. Life insurance can help replace the lost income for survivors and their dependents. It may bring peace of mind knowing that the funds will be available when needed. The survivor may not have to worry about whether or not they have met the age requirements to receive a widow's benefit, or whether or not their earning will impact the life insurance death benefit if the surviving spouse needs additional dollars before full retirement age. If you're looking for ways to receive the guaranteed benefit increase by earning delayed retirement credits, you might want to consider using a short-term single premium immediate annuity. The income from the annuity can allow you to maximize your Social Security payouts and earn delayed retirement credits while postponing election of their Social Security benefit to age 70. This could potentially maximize taxation on benefits because Social Security benefits are considered a tax advantage income. A single premium immediate annuity is a contract with an insurance company whereby you pay them a sum of money up front, known as a premium, and they promise to pay you a guaranteed income stream for a specific period or for the rest of your life. They are long-term investments designed for retirement purposes. Distributions are subject to income tax. If you remember from a previous slide, we discussed the formula for taxation of Social Security benefits. The formula only considers one half of your Social Security benefits as income versus 100%, and the maximum amount of Social Security benefits that can be considered for income taxation is currently 85%. So the greater the income received from Social Security, the more tax savings you may receive. If you have further questions, call 512-290-3019 or visit MedicareChampions.com and subscribe to our page to speak to a licensed benefits advisor. Thank you for watching this video. If you would like help determining how taxation may impact your current retirement assets, or even how diversifying those assets might benefit you, I can help.